Let's break a common belief that most of the NRIs in their 50s have, that if they have not made it financially yet, then it's too late. If you're watching this with a mindset thinking, I have figured out how I'm going to invest in my 50s, then what I'm about to say in the next stages might actually feel a bit uncomfortable. But if you watch it with an open mindset, then this could protect your retirement, give you peace of mind and for your family as well for the next 20 years. If you're new to the channel, welcome to B&IE. My name is Wilf. I've lived in the UK for the last 15 years and navigated through complex financial situations so that you don't have to. And if NRI finance actually feels a bit confusing for you, then you've come to the right place. So stick around and let's find out. Stage 1. The biggest mistakes that NRI make in their 50s. Overpaying their mortgage. Now listen, overpaying the mortgage is absolutely fine, but in your 50s, it's costing you a lot, especially when you are trying to put away a bulk of money, overpaying your mortgage, thinking that that is the biggest debt you have currently and you need to pay them off quite quickly. It feels right, it feels responsible, but the problem is you're throwing away all your money into overpaying a mortgage, which charges you between 4 and 5% interest rate. When you overpay your mortgage, you're taking away that overpayment or that money's opportunity to grow at the rate of say 8 to 10%. The other thing that you have to realize is overpaying the mortgage means you're locking away permanently that cash into the loan, and you have no opportunity to take away that money or take that money and do something about that. It's not in the form of a liquid asset. It's tied to a property. The only way for you to realize that is to sell your property or borrow more as a form of home equity line of credit. And in your 50s, liquidity matters more than being debt-free. Mistake number 2, investing in Bitcoins. Now, I have seen this notoriously being done by people in their 50s. They tend to think that because they have missed their opportunities in the past, the only way to catch up with their lost time is to invest into risky assets such as Bitcoin. And most of the people tend to get into the Bitcoin realm when the market is really high. They get into buying Bitcoins when the Bitcoins are really at its peak. And what happens after they buy? Obvious thing, which is it corrects and then people are pulling out the money. And what happens? The person who's invested the money, a lot of money at their 50s, at the highest peak of Bitcoin's rate, you have your money completely captured inside this. And when it gets tied into this Bitcoin, you have to stay invested longer just to get your money back. And in your 50s, you haven't got that kind of time frame. When you're in your 50s, we have to get a little responsible and not become speculative and invest into risky assets such as Bitcoins. And when the Bitcoin crashes, you don't have 5 to 10 years to recover your loss. Speculation belonged in 30s. This is the time for you to think about your retirement, not the time to speculate. Mistake number 3, and this is something that most NRIs are guilty of, entering at the wrong stage of their career. And in your 50s, buying a property in India is a very risky investment. Let's say you've saved up some money and suddenly you think, okay, you need to start building this up. And one of the advices that you get from your colleagues or your family members is to buy a property in India. Why? Because the property prices are going up. And in the future, let's say in the next 10 to 15 years, you might be in a position to actually sell that property at a profit. There's nothing wrong with that. And you possibly will be able to get that kind of return as well. But here's the truth that no one actually tells you. You're taking a stronger currency and converting into a weaker currency and investing in an asset which gives you a rental yield of between 1 to 2%. And the next thing is, when you buy that property, you have additional expenses. You have to consider about paying taxes, TDS, maintenance costs, and repairs, painting work, And when the tenant moves out, you need to find a new tenant. So you're investing into something that requires you to be in an active property management mindset. And when you're in your 50s, you do not have time to think about all of these things. And at this stage, you don't need an asset which actually gives you a headache. Instead, you need an asset which gives you clarity. Here's the part you need to understand when you're investing in property in India. When the time comes for you to sell the property, you sell it. And when you are deciding to send the money back to your home country where you're currently residing, you have to worry about the currency conversion rate. You have to worry about the taxes that you have to pay in India, and also taxes that you have to pay abroad as well. At that point in time, your investment wouldn't actually give you any forms of return. Mistake number 4, investing in Indian stock market. And I'm guilty of that as well. And I've realized that's not the right way to do it. And that's not the way an NRI is designed to build his wealth. Investing in Indian stock market is nothing wrong with that. But the problem is you're concentrating all of your savings into just one single market. You're buying and picking stocks which are traded in the Indian stock market, and you're concentrating all of your investment on one country's performance alone. As an NRI, you have plenty of options where you can invest your money. You can diversify your investment globally. So why would you actually put away all your money into one single market expecting it to grow? If your income is abroad and your spending is abroad, then why would you put away all your money into a risky asset such as investing in just one single market? This is same as putting away all your money concentrated on one single company expecting it to grow. The chances of that working for you is very, very slim. In this global environment, when you have so many options to diversify your investment, you shouldn't be putting away all of your money into one single market. Stage 2 is correcting your foundation, understanding how you can progress your investment. This stage is not about getting rich. This stage is about protecting what you've actually built. First one, open a stocks and shares ISA account. This account is specifically for UK people, but if you're living in the US, then you have other options like 401k, Roth IRA. Explore those options that are available for folks in the US. But here in the UK, you have stocks and shares ISA account, and this account, the beauty of that is it allows you to invest up to £20,000 each person. So for yourself and your wife, if you have savings each year more than £20,000, make sure you have 2 accounts open. That way it gives you opportunity to save and invest into something which can grow and gives you tax-free return. And any capital that you gain, any dividends that you make out of this account is completely tax-free, and you don't have to pay a penny to the government. It's an absolute no-brainer for anyone thinking about investing. And especially if you're investing in your 50s, this is the best option available for you. You can open this account using with one of the providers. I would recommend you to use Trading 212 because they don't charge commissions or there is no annual fees associated with it. And it's a very easy platform for you to use. If you've got other platforms that you want to choose, there are plenty of them available, but make sure you read the fine print, because some of the banks such as Barclays, they charge you fixed rate of fees each month, and any transaction that you make, you might be paying more money for that particular transaction. So try and avoid that, and do not go into somewhere where there is too much fees associated with it. Try and keep it simple. There are platforms such as Moneybox as well. They do charge you a fixed amount of fees each month, but it's not as high as the banks that they generally tend to charge. And when you invested through this particular option, you're creating a tax efficiency. And when there is tax efficiency, that equates to higher return. With Trading 212, it's simple, it's less complicated, it's low cost. And at this stage in your 50s, complexity is the enemy number 1. So try and keep it as simple as you can. Next step is to invest each month into ETF. Now, using your stocks and shares ISA account through the platform like Trading 212, you have the opportunity to put away a fixed amount of money each month into buying ETFs. ETFs are the most secure way for you to invest. You can invest into an index fund such as S&P 500. You can invest across the globe by investing into FTSE All World Index. You can also invest into emerging markets such as India, China, and other Asian countries. In your 50s, you're not doing any speculative work. You're not picking individual stocks and things. The beauty of this is that your investment isn't concentrated on one country alone. It is diversified across the globe. Even the best traders in the market tend to get this wrong when they actually invest in individual stocks. So in your 50s, you don't have that kind of risk appetite. Invest into safe and secure way, which gives you steady growth. It might actually look a little boring, but between 15 to 18 year window, you can give that opportunity for your money to grow. Your consistency is more vital than chasing excitement. It might actually feel great to pick individual stocks. When it performs, you feel you've achieved something. But remember, there are other stocks which actually don't perform at that point in time. So whatever returns that you make from an individual company, it may balance out the losses of other companies. Don't try to go in and invest into individual stocks at this stage. Stage 3 is acceleration. This is where your investment would start to feel real. This is where you will be able to put a number to your retirement sum. When I started this video, I didn't specify as to how much you would be in a position to save up and build your wealth in 15 to 20 year period of time. It's all down to individual contribution and their risk appetite. When you have built a steady flow of investment and you're contributing each month into these investments, you've already overcome the biggest hurdle. When you come to the stage 3 section, this is where you want to speed up your process. You want to catch up on things that you've lost, the lost opportunities in your 40s or 30s. And this is the time you can do that. There are 3 ways you can do that. First one is trying to beat inflation. One of the ways you can beat the inflation is trying to add 5% additional contribution each year. And you can do that various ways. Each year, try and increase your contribution. So let's say if you're contributing £100 each week, increase that by 5%. Say add another £5 or $5 extra addition to your contribution. Build that and keep that momentum going each year. And you would not even realize how much it will grow into at the end of your financial contribution period. 2 is redirecting all your leftover cash. Let's say you're contributing excess amount of money into your mortgage. You might want to consider taking that money out. Remember, you're paying off a loan which is between 4 and 5%. You can give that money the opportunity to grow at a rate of 8 to 10%. So why would you pay off your mortgage? Instead, let that mortgage run its cycle. You take that money, put away, and give that opportunity for you to grow. So direct that money into it. And if you've paid off any loans, then that's a perfect opportunity for you to redirect that money into investment. Remember, if you haven't paid off all your credit cards and any loans that are charging you between 9 to 30%, then investment shouldn't be your first priority. Your first priority should be to clear off all the loans that you have currently and make sure that you've cleared that out. That way you can start fresh, and when you start fresh, you have all the available cash to concentrate and to invest. Don't leave any money in the savings, because that's just eats away due to inflation. It's not going to give you any return. And especially banks such as Barclays and everything, it actually gives you like 1% return. So why would you park 20,000, 30,000 pounds into that savings account? Build yourself an emergency fund first. First thing for you to do is to make sure you calculate what's your monthly expenses. If it is between £3,000 or $3,000, multiply that by 3 or 6 months. Take that money and put it into an emergency fund account, which gives you high yield interest rate. That way that money is also growing and it is easily available for you to access when there is an emergency. Once you've built the emergency, you shouldn't be putting any extra money into that account. Instead, you should be putting away all of that money into investing into ETF, because you're giving that money, the cash, the opportunity to grow faster. And idle money sitting in a bank account loses value quite quickly. So do not do that. 3 is to protect your lifestyle and not your ego. And I've seen a lot of people, when they start making additional money, the first thing that they think about is buying that fancy car or buying that fancy mobile phone. These are all expenses. You don't want to be doing that in your 50s. Instead, set a goal, set a predictable income pattern, create low stress. You don't want to be spending. You should be thinking about investing and building that retirement fund, because you've got 15 to 18 years of good income years, and utilize that period to grow as much faster as you can. Be disciplined to invest and grow your wealth. Your 50s are not too late. Like most of the people actually tell you that 50s are late for you to start investing. Absolutely not. This is the perfect time. The reason is you've cleared out majority of your loans. You don't have many credit cards at this stage, and your income is pretty strong as well. It's a perfect stage for you to accelerate your growth. You've got 15 to 18 years of time to build your retirement fund. This is the decade for you to make smart decisions. If anyone in their 40s or 30s watching this video and want to learn more about how you should be investing, then comment your age and I will make separate videos for you. And if this video gave you clarity, stay subscribed for more, as I drop a new video each week on a Sunday morning. See you in the next one.